Okay, we're moving on now. So I haven't yet pulled in this chart that you keep seeing in your textbook. So I got these, brought in these excerpts from page 622 of the textbook and 623. So these two here, and I thought this is the right time to look at it. I'm sure you've looked at it yourself, and I hope you understand what it's laying out. But basically, you can see this is where we started in A, liability for tax, and we spent a ton of time in B figuring out what is it that gets taxed. And so basically, what is your income? If we're going to tax something, what is it that we're going to tax? Well, Division C is really, for all intents and purposes, part of that. But the reason that it needs to be its own division is, and you can see what they pull out here for us. So things like donations, foreign tax, we won't look at loss carryforwards, and dividends. These are things that they can't really bury within Division B, because within Division B, when you define income, a loss clearly doesn't fit into that, right? And when you define income and you have dividends flowing across taxpayers, across corporations, it can't be handled within Division B. So that's why Division C exists at all. So you can see, really, without these complications, we would just pay tax on our Division B income. But Division C is necessary for these sort of odd situations, these times that just different things happen. And so this stuff here, actually, we can cross out for now. We're going to look at that in a couple of weeks, the computation. So we're going to have a look at exactly how we calculate tax. But for now, really, I think what we want to look at in this video fairly quickly, I think, is just the losses and then the dividends. So let's talk about losses. As I said just a minute ago, losses are problematic because they are negative income. And so if we're going to tax something, if we have negative income, it's going to cause us a little bit of trouble. So basically, the whole idea with losses, the trouble arises that if taxable income is negative in any given tax year, then no tax is paid. But so that's all fine and good, but no relief for the expenses is given either. And so we've got this. So if you think about it, if they have a loss one year, if there's no way for that loss to sort of go across tax years, then it's very possible that I'll have to pay no tax one year, but incur losses. And so I will, for the expenses that I incur within that year that drive me negative, I'll be paying 100 cents on the dollar for all of those expenses. Whereas the next year I'll be paying tax on the revenue that those expenses most likely helped to generate. So recognizing that the timing of expenses and revenues, even though we try to with the matching concept, we know that they don't always match. So that's the whole problem that has to be addressed here, and that's what Division C does. So we're not going to go into too much detail because the problem we do in class is fairly detailed on these things. So really, let's just look at non-capital losses, and we'll get two important concepts for both for each of these things. So we have carry. Oops, sorry. Let's just go with forward and back. And what this means is Division C puts a limitation on how, if you incur a loss, against which income can that loss be applied? Which income can that particular loss, reduce? And so for non-capital losses, which is for our purposes business and property, those losses, anything that's not capital in nature. Okay, so you can see that really when a business is, I know we've worked hard at coming up with business income and property income, but when you look at up here, they're just, they're one line, and really the only other thing that businesses can do is capital gains and losses. Anyway, so we have non-capital losses, so basically everything except capital can go back 3 years. So if I incur a loss this year, I can go back and apply it against previous years, and they can go forward 20. Now, we'll asterisk that because we're in this time of transition right now where 7 and 10, you'll see in your textbook, but for our purposes, 20 is the number. Okay, and then net capital losses, so capital losses that have been had the inclusion rate applied to them, they can also go back 3 years, and they can go forward, indefinitely. Or forever, depending on how you feel philosophically about the word forever. Okay, so let's just get some notes here about how these things are worked. So these are tracked on a net basis, meaning, and all that means is that we're not tracking the loss, the actual loss. We're tracking the loss after inclusion rate. So what that means is the inclusion rates have to be reconciled. So we're at half now, and we've been at half for a while, but it's not that long ago that we went from 3/4 to a half in transition. And so basically we just inclusion rates have to be adjusted. Okay, it's just a mathematical exercise, but it causes us grief because we're going to have losses if we have losses in 2012 that we want to offset against gains that were that are incurred so let's do it the other way. Let's say we had losses that were incurred in 2000 when the inclusion rate was 3/4, and we want to offset those against gains we have this year. We have to make sure that we're matching apples with apples. That's basically it. Okay, and the important thing to note here in terms of the process is that when we carry things forward, this is on a pooled basis. So basically a pool is tracked. But because of these expiries, each individual loss each year has to be kept. So you can't just throw them all in. We have this one pool of loss carry forwards, but each loss is aged because this expiry can matter. And you can imagine, I'm sure, that when it was 7 years, this was a much bigger deal. The expiry was a much bigger deal. And in fact, it is for companies right now, right? In 2013, a lot of companies are going to have losses expire if they don't use them up, and we'll talk about that in class. And going back, what this means is amended tax returns. Okay, we don't have an ability to see the future, just so we know. So when we filed 2011's tax return, we filed it. If 2 years from now we have a loss that we can carry back to 2011, that means we're going to file an amended 2011 tax return. Okay, so it means we're going to go back and refile our 2011 tax return saying, now that we know about this loss in 2013, here's our new 2011 tax return. So the government will have had tax that we paid and will refund it, but they've held on to it for the time that it's been there. Okay, and that's essentially all we're going to say for now anyway about losses in Division C, is that Division C makes it possible for losses to move across years. Okay, so moving on then, the other thing that we want to talk about is dividends. Okay, so the reason that Division C needs to deal with dividends is, well, let me just set up a quick scenario here. So say I've got a taxpayer. So here's a shareholder, and he owns 100% of Company 1. Company 1 owns 100% of Company 2. And so this is a nice simple scenario where all of these are 100% ownerships. Okay? If that's the case, dividends are a problem for tax because dividends have to be paid. So this is, first of all, I'm going to look at within Canada. Okay? So within Canada, let me just get dividends in the general first. So the dividends in general, the reason they're a problem is that they have to be paid to the immediate shareholders. Okay, meaning So let me just get that down. So immediate shareholders. Okay. So what that means is that C3 in our example here, they can't pay a dividend. To any to let's say it in the positive, can only pay a dividend to what? C2. That's it. Right? And so as you see in your textbook, if we didn't have division C that exempted that allowed these dividends to flow through, because ultimately these dividends, any income earned by any of these companies belongs to this guy, this person up here, the shareholder. But if we didn't have division C exempting or allowing us to deduct these dividends that are coming into income, so if C3 pays a dividend to C2, it comes into C2's income. If C2 can't deduct that, then we're having that dividend, that income that is earned in C3 taxed 1, 2, 3 times before it even gets to the hands of the shareholder. And because we have the concept of every dollar is taxed once, we need this to be here. So essentially what Division C does here then is within Canada now, so these are Canadian dividends. So that basically means this entire scenario is in Canada. Okay, so there's nothing foreign going on here just yet. Division C allows dividends to, you'll hear the term, so we'll use it, flow through. So in our case, it allows them to flow through C2 and C1 to get to shareholder, to be taxed in shareholders' hands. Okay. So basically what it's doing is it's saying it doesn't matter, it shouldn't matter if this corporate structure was just one corporation or 3 corporations. At the end of the day, the income earned by the holdings of shareholder in total should be taxed when they're paid as a dividend to the shareholder. Otherwise, they're retained in the corporation and nothing happens. The second thing, though, or the second issue with dividends is foreign dividends. And what this is, so let's just quickly draw a scenario. We won't bother involving an individual in this one, but we've got Company 1 owning 100% of Company 2, and then we've got a border being crossed. Okay? So it's important. So again, this is 100% ownership. So if my and this is Canada up here. So if my Canadian company owns a foreign subsidiary and a dividend comes up and crosses the Canadian border and comes into Canada, Division C, so again that would be included in income. When C1 in Division B, Company 1 would include it in its Division B income. Division C needs to exempt that. So why does it need to exempt that? Because this is the international tax system that Canada has come up with. It's basically exempt from Canadian tax. So the dividend, let's put foreign dividend. Okay, so this is a dividend from a company that I control, is exempt from, that is not even close to the word Canadian tax if, so this is important, Canada has a tax agreement. So usually a treaty, but we have these new agreements now that are around. But you can think of this as treaty, tax agreement with the foreign country. So that's the international tax system that we've come up with, or that we use in Canada. It basically says if it's taxed in the foreign country, so if it was taxed down here in C2, then Canada won't tax it when it's paid up as a dividend. We will let the country tax it, and Canada won't tax it.